This discussion will focus on the Rental Assistance Demonstration, the HUD Multifamily Accelerated Process, common issues and lessons learned. The RAD Property Condition Needs Assessment. RAD is a physical needs-driven program. A study done by HUD in 2010 determined that approximately $26 billion in backlog capital repairs are in the public housing stock. By today's current estimates, is bordering on near $50 billion. And every year of inaction results in a $3 billion annual accrual in additional repairs. This is the reason why RAD came to be. The RPCA is really 3 scopes of work in one. It includes a capital needs assessment that's been greened by a lead AP professional. It also includes an energy audit, which is an ASHRAE Level 1 energy audit, and a utility consumption baseline, or a UCB. Together, these 3 components create the RPCA, a holistic view at property use, property energy use, property condition, and long-term capital needs. One of the most important things in a successful RPCA is selecting the provider. Qualifications, experience with mixed finances, experience with the multifamily accelerated process, and experience with the RAD program with documented successes should be things you're looking for. Deliverables for the RPCA include both an Adobe Acrobat hard-written report as well as an interactive Excel tool. The Excel tool is a workbook provided by HUD that the needs assessor needs to complete. That Excel tool swims to the client, to the lender for their review and their augmentation or changes to it. A key part of a successful RAD program is to understand the Excel tool functions and objectives. So RAD with HUD Mortgage Insurance is a common topic. As we know, within RAD there's really 3 types of projects we'll see. We'll see those that need little debt or don't want to achieve debt. We call those preservation projects, or using cash on hand. In the future, HAP contract as the income stream to pay for repairs. The second type of RAD projects are those that need moderate repairs, typically a refinance transaction to free up some dollars that can be put into the repairs, $5,000 to $10,000 per door on average in the refinance structures. And the last structure we'll see is the actual projects need a lot of rehabilitation. And those will typically access the equity markets, the 4% bonds and the 9% tax credit markets. The second and third bucket of RAD projects I discussed may access the HUD mortgage insurance industries for debt and equity structures. So for projects that will pursue FHA mortgage insurance programs, understand that the RPCA is fully MAP compliant, with the exception of some certification language that it omits that we can add to a rider, and there are some specific HUD forms required for the multifamily accelerated process program, notably the reinsurance form, the 92329, and the appraisal form 92264. So RAD with Section 223F, that second bucket I described, the projects need a little bit of debt to get by, but not a major rehab. 223F may be a very nice program for them to access. One of the neat things about it is that program within MAP is driven by Mortgagee Letter 2012-25 that is applicable to RAD, and much of that language is in the RAD scope of work. Also understand that the RAD toolbook that HUD gives us, that second component, the Excel tool I talked about in the previous slide, that has defaults in it. And the defaults default to $1,000 per unit for the ongoing replacement to reserve, or the PUPA, per unit per annum deposit. The important thing to understand is that default is not cohesive with Mortgagee Letter 2012-25, and that can be changed based upon the 20-year expenditure metrics. If we decide to do RAD with a LIHTC pilot project, and this is the LIHTC pilot under 223F, it's very possible. One of the great advantages of the LIHTC 223F process is sheer speed of transaction. If you have LIHTCs, you can go with the 223F for a fast commitment, as long as we're not spending greater than $40,000 per door in rehabilitation expenses. One of the problems with RAD and the LIHTC pilot is the RAD program statutorily requires Davis-Bacon wage rates be used for all construction costs. Under the LIHTC pilot, Davis-Bacon is mitigated, but it cannot be for RAD projects, so please be aware of that nuance. The third type of RAD project I explained were those that need a lot of debt or equity structures. These are ones that need $15, $20, up to $60, even $100,000 per door in rehabilitation. Those will typically seek the 221D4 substantial rehabilitation program. Another problem with the RAD and 221D4 program is remaining economic life issues. Many of the HUD mortgage insurance programs have maximum loan terms that are based upon the remaining economic life of a property. Therefore, if the remaining economic life is stunted or held back by an appraiser or reviewing HUD office, it could limit the loan terms. One interesting note on the waiver of the RPCA is beware. We're involved in many projects where the RPCA could be waived or was waived and maybe shouldn't have been waived, or we're glad it was not waived. A good example is when you're in a project and the scope of work starts being value engineered. Things come into the scope of work, things go out of the scope of work. Things change in the scope of work. All those dynamic changes could technically affect the reserve to replacement deposits. And within the 221D4 process, at the time of submission, the lender needs to provide a reserve to replacement deposit based upon the project post-rehabilitation. However, if the RPCA was waived, it is possible there is no reserve for replacement deposit created yet for the project. And for this reason, the RPCA becomes an integral part of the planning process for most substantial rehabilitations. Many industry practitioners, affordable housing consultants, and lenders still see the RPCA as a very important tool even with D4 structures, even though it can be waived. Well, let's get into lessons learned with RAD. Dominion Due Diligence Group has been very fortunate to assess over 18,000 units of RAD. So these are a few of the things that we find that are important to be on the radar screen before you get in. When you go into a RAD project, go in with eyes wide open, please. The first one is don't be afraid of RAD. It's not rocket science, but it does take patience. It's a lot of acronyms, it's a lot of new terms, but there's some great industry practitioners that understand the program and trust in them. But don't be afraid of it. Embrace it. It's a great program. For me, it's the most innovative preservation program the federal government's ever put forward. Item number 2 is PHAs often don't have an accurate assessment of needs. Some do, some don't. The original 60,000 RAD applicants all had to size their needs in advance of an RPCA. In hindsight, most of those needs were well undersized. We're finding that many of the original adopters of RAD do need much more rehabilitation than they originally thought. And people ask me why. And really it comes into a question of preservation versus recapitalization. And I explain it best by talking about cabinets. We've been in many public housing environments where the head of maintenance says, look at my cabinets, they're in great shape, and they are in great shape. They've been repainted on every tenant turnover. They're still fully functional for the tenants they serve. However, those cabinets are 1965 vintage that have been painted 20 times. They're in good shape. But they're 40 plus years old, 50 years old. In the world of mixed financing, when an equity provider comes in and an investor in a property brings capital to the deal, they want to ensure that it's been recapitalized properly, and one of those is those cabinets will most likely have to be replaced. So there's a disconnect. The housing authority thinks they're in great shape, fully functional, and they are. However, in a transaction to preserve the project and extend these renewing 20-year HAP contracts, certain investors want to make sure those cabinets are replaced. So bridging that disconnect is an important lesson learned in RAD. Smaller public housing authorities are generally more challenging. This is across the board. Why? Typically their budgets don't allow them to have a very diverse staff. Typically the director is also the maintenance person and the voucher authority individual and wears many hats. Therefore, their savviness in mixed financing may be decreased as opposed to a larger housing authority that has multiple staff members in multiple roles. So more challenging, more patience with the small PHAs is needed. Number 4, very important to identify expectations and goals early on in order to meet the HUD milestones. The RAD program has something called a CHAP, a Commitment to Housing Assistance Payment, and in there are very rigid milestones. Those need to be followed. In order to follow those milestones, expectations and communication is paramount. We need a goal up front to hopefully we can get there in the time frame they want. Number 5, very important to identify and available predictable sources of financing early on. The reason we put this in there is because certain financial sources can have their own capital needs. So identify any sources you have, whether they be home funds, Federal Home Loan Bank funds, tax credit funds, municipal bank funds. All those may have needs of their own that a needs assessor should be aware of. Number 6, discuss and identify existing EPCs and CFFPs, more in acronyms. EPCs, Energy Performance Contracts. These are common in public housing. Public housing could not incur debt. So in the past, when they needed new boilers, new windows, new energy saving devices, they actually bought those from they signed a contract with an independent third party, an energy performance contract, whereas the entity that brought those systems in gets to share off of the savings for the energy consumption over a period of time. If those are in place, they may have to be bought out or detangled during the RAD structure. CFFPs. It's a capital fund loan program where public housing authorities can borrow money in advance of their capital funds. If those are in there, those loans to HUD need to be structured and paid off. So beware of those. Number 7, remember long-lived building systems. Mortgage E-Letter 2012-25. The previous slide I talked about how in some of the HUD mortgage insurance programs the remaining economic life becomes a very large issue. This comment here, long-lived building systems, directly equates to an extended economic life. By this comment, HUD really wants us to make sure we're looking at the sewer lines, elevator components, building components that have an EUL of 35, 40, 45, 50 years to make sure that they're still going to last the loan term. And if not, should we be replacing those now while we have the chance to recapitalize? Number 8, municipal involvement pre and post conversion. This is best described by a case study we're going through. We're currently in a RAD project. The streets and the parking lots and the sidewalks are all maintained by the Department of Public Works. It bears the question that upon RAD conversion, where the project is no longer within the Public Housing Authority's portfolio but is a mixed private-public partnership, will the municipalities still maintain those roads, maintain those walks, and those site components? In this case, we went and asked the DPW about that arrangement post-RAD conversion, and it was confirmed with us in writing that upon conversion they will have no responsibility to maintain any of those features, and they would be the responsibility of the property. That changes some of the structure in our review because items that were before not in contract now become in contract because of the municipal involvement change during the conversion process. So vet out those things if you think those apply to your project. Number 9, coordinate the environmental site assessment early. This is paramount. It should almost be number 2 on my list. And why I say this is because we can get down the road 4, 5, 6 months with capital needs and things look really good, and then the financing structure requires an environmental site assessment. And in that study lies the problem that we find may be a barrier to mortgage insurance. Example being a floodway might be running through the property and now we can't access some of the mortgage insurance programs we wanted. Or there's a high pressure gas line going through the project which didn't present a capital assessment concern or capital need concern, but is an environmental issue when we go after mortgage insurance programs. So think about coordinating environmental early, not late. Number 10, Davis-Bacon wage rates cannot be avoided within RAD, even in the LIHTC pilot. I hinted on this before. I want to say it again. We must pay Davis-Bacon wage rates with all repairs within a RAD project. That's statutorily required. Number 11. So some functional obsolescence issues we typically see in the public housing stock would be Things like 4-bedroom, 1-bath units, or non-elevated handicapped projects, accessibility limitations to a project. Those can all be examples of functional obsolescence we need to address. Number 12, get to know your transaction manager and communicate. HUD assigns a TM to each of the RAD projects. You should communicate with them early. Let them know where you are with milestones. Talk about concerns, problems. Your needs assessor should get to know who they are as well. All that communication makes your deal that much easier to process for HUD. And finally, number 13 of RAD Lessons Learned, review HUD's RAD FAQs frequently. On radresource.net, this growing list is up to 55 pages of Type 8 font. It's fluid, it's dynamic, constantly growing, and a great way to understand some new policy initiatives or interpretations within RAD. So creativity in RAD, the first one being rebranding of a PHA. We've now had 3 clients do this. We've taken the public housing element out of their name alone. Takes the stigma away from them, and now they are truly a community redevelopment organization. So rebranding is a great way to go. I say creativity is making small work for all, and I talked about small PHAs being challenging. But sometimes we have very creative structures to make them work. I can think of one in a very rural state where we have 3 small PHAs discussing the idea of coming together as one entity, closing the public housing authorities are creating one local development group to make RAD work. Interesting idea. I have another small PHA that, because they only have 120 units and the synergy wasn't there, we looked at available land next door. Now we're building new, combined with the RAD deal on the smaller project, to do a mixed finance 9% deal as a whole. Again, making small work for all. Number 3, portfolio analysis to create synergies and rent bundling. HUD encourages this. And we recommend to our clients that are medium to large PHAs to assess the whole portfolio stock under RAD. Think about synergies between projects, which projects go best with other ones. Because though they may be individual AMPs now, it doesn't mean they can't be one property later. Example being, we worked with one housing authority where 18 different assets became one bond deal and one asset for the rent bundling and the synergies. It works. Number 4, creativity. We find that the preservation balance between IDRR and ADRR is very important. IDRR is the initial deposit through replacement reserve, and ADRR is the annual deposit through replacement reserve. Recalling my former discussion of the 3 different types of RAD projects, type number 1 were those that were going to achieve no debt, hopefully. Use cash on hand or ongoing HAP contract payments to solve their needs. This preservation balance becomes very important to understand at that point. We're trying to structure a project to not incur debt. That's creativity. Number 5, reducing expenses through energy upgrades is a very important thing in RAD. In the RAD conversion process and really looking at some of the debt structures, we're often finding that the expense ratio is typically higher than what you'd usually find in multifamily housing. We're trying to reduce that expense ratio by really putting in green systems, doing retrofits, and modeling the energy use in the future. Within RAD, we're able to actually underwrite those prescriptive. Within RAD, the underwriter is allowed to acknowledge those energy savings to reduce utility burden. So creativity in RAD, number 6, use of Section 18 demo disposition. We have many public housing authorities that are using HUD's Special Assessment Center to take units offline and replace through new construction elements. Or we're taking properties offline, moving those rents, and not demoing the property, but structuring it to go for a 9% tax rate application 2 years down the road. These are all very creative structures making RAD work. And number 7, complexity is the normal. So don't get scared. Think outside the box. We had one that was a RAD conversion. After the RAD conversion, they sold the building with a land lease, 99-year land lease back to the owner, and they're going to build new inside the city. 2 for 1, really, they got into RAD. I mentioned before portfolio, and here I show an example of 15 projects in the one bond deal. And another example of complexity, but it's a new normal, is scattered site projects. We recently did 157 scattered site townhomes in an inner city that closed under 221D4 structure with RAD. Very exciting. So with that, I will end. I welcome any concerns, questions, future dialogue. We're all here to make RAD successful, and the lessons learned from all of us are important to hear.